Welcome back to Sharing Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me today, not just for a couple of minutes, but for a little longer period of time, Michael Oliver. Thanks for joining me again, Michael.
It's great to be back, Jay.
Always good to have you with me, and it's always good to tell my listeners that your website is olivermsa.com, olivermsa.com. Michael, in a message you sent to me earlier today, you noted that your service, that is MSA, likes to treat markets as being linked and mutually distorted by the Federal Reserve, by other central banks. You told me now that more than ever, you can't simply look at the given price charts and make any sense of it. You really have to look at the interrelated parts or the interrelated markets. Can you expound on that a little bit more?
Yeah, MSA began in 1992, and we primarily, our subscribers are high net worth investors or mostly institutions of varying sizes. So we provide private technical input, but of a different kind than what you think of when you think of technical analysis, which usually entails price chart analysis. Mm-hmm. And in particular, in the last 5 years, central banks, not just the Federal Reserve, but ECB, Japan's, the BOJ, and so forth, have exerted extraordinary pressures and measures to create pricing in various markets, particularly in equities and in debt markets, pricing that they thought was appropriate, would achieve what they thought from their academic perspective would, produce the great world. And they've been doing it for 5 years now, and it has greatly impacted equity prices, I think, especially in the U.S., in terms of higher than they otherwise would be. Mm-hmm. It has especially affected debt market yields to lower than they otherwise would be, or prices of bonds higher than they otherwise would be. But it's also affected other markets, because when you generate a move in one market, you tend to take investor capital that might go somewhere else, and it'll go to that happy market.
Right.
Investors, they go for the feel-good. And
right.
For instance, in 2011, when a lot of this stuff really began in earnest, commodities peaked. And we noticed it at the time, of course, that's when gold topped in late 2011. But it took an excruciating amount of time for that top to really take hold and then the collapse to begin. And in fact, gold didn't really collapse till 2013, April through June. And many other commodities were peaking during that period as well. So were the emerging markets, which, as you know, the emerging market stock markets were the popular place to be. And they did a lot better than the S&P in the initial part of the recovery after the bear market. Mm-hmm. But they joined commodities and went down. But it took a long time, an arm wrestling period of time, to finally roll over so that investors placed their money where the Fed wanted them to place it, namely in the developed market stock indexes, the DAX index, S&P 500, and so forth. And they got their money's worth. But that's ended. Most of these developed market indices are well off their 2015 highs. Only the U.S. blue chips are the exception, and they're not doing all that great. S&P today, for example, traded where it was in July and May of 2015, and only about 2% higher than it was at the peak in 2014. Mm-hmm. So, but the main point here is that looking at price charts, especially at trend change times, is usually the worst place to look, because price is the last technical indicator to provide you with the information that I've topped. By the time price is obvious that it's topped, in the case of stocks, or bottomed in the case of commodities, you're so far off the high or the low that you've missed a good chunk of the move. So our work focuses primarily on the momentum of price, particularly long-term momentum, annual momentum, and quarterly. And we see the evidence there first. But the other point is the interrelationship between these markets. When equities top out or don't perform well, investors need a place to go, and that they're denied yield by the central banks. They've been denied yield for several years now, which hurts a lot. And therefore, they're really antsy about finding a place to get return on their capital or yield. And commodities were, as we expected, the place to be this year. Now, it's not all commodities yet, but it's primarily been led by gold and oil, for example, which even despite the recent pullback in gold is well up on the year compared to, for example, the S&P 500. There's no comparison in return. And oil's up vastly on the year. We see the evidence that the play for 2017, for example, which is developing and taking its excruciating amount of time, are the food commodities. That would be the grains and the meats. They look like the last to bottom, and probably a great place to be for next year. If you're not early long oil and gold, you've missed a good chunk of it. But those markets look like they're going to be the late comers in the commodity arena. And that will, once that occurs, it's our belief that such indices as the Bloomberg Commodity Index, which there's some ETFs on it, for example, which is a basket of all commodities, will in turn spark a collapse in the bond market. That has not yet occurred. We've been measuring the bonds, the Bunds in Germany, and the JGBs, the Japanese government bonds. And while we see them as having probably topped, they've not really triggered the kind of structures that will flush them out, that will really produce higher yields and lower prices in those markets. They're playing with the numbers, but they're not breaking them yet. But that's been an arm wrestling match as well. For instance, bonds peaked many months ago in price, but they won't collapse yet, and I think that's coming. I suspect the interrelationship there that will cause that is that the Fed and the ECB, who have been begging for 2% inflation, are going to get that times 3, or 4. And it's going to come when the food commodities join with gold and oil, and next year start making a lot of noise. And that's when you're going to get, I think, finally some fruition. So investors who've been placing bets maybe in alignment with what I've described, like topping stocks or bottoming commodities, and have been frustrated by the zigzag or the dormancy, I think they're going to be rewarded because the evidence continues to mount that that's the direction that we're headed.
Yeah. Well, I think I saw somewhere today, Michael, that I guess it's the CPI they look at or whatever index they're looking at for that 2% number, that we've had 11 straight months where it's at that level or slightly above it. So the Fed is having a harder time now justifying not allowing rates to rise by pushing and suppressing the rates by pushing money into the system, right? So they're constantly doing that, manipulating the rate, and in my view, destroying capitalism. Because how can you have capitalism if you don't allow price discovery of capital? It beats me. And maybe they don't really want capitalism. I don't know what their
that's a good
what their issue is. But so you have this 2% suppression, and you got all of these happy talkers saying that, the economy is going to, finally we'll get that liftoff that we've been looking for from all this Keynesian stimulus, and yet it doesn't come, and yet they have to keep pretending that it's there because they don't want rates to rise for the wrong reason, right? They want the Federal Reserve and the central banks to be in control, or at least people that think they're in control. I'm just wondering, Michael, if, is the Fed really in control, or might the Fed's hand be called? It might have to allow rates to rise just simply because of economic pressures.
Well, the bond market rates have risen, 10 and especially 30-year have risen markedly in the last several months.
Yeah.
Not enough to precipitate the major collapse in bond market pricing and sharp rise in yield. We think the yield, for example, which has been either side of 2.5% on the 30-year bond, could jump to 3.5 to 4. So that would be an earthquake. And we think that could happen in a matter of months once certain levels are violated. And they haven't been violated yet. They've been playing with them, I'll tell you that. We measure them week by week. And it's interesting what they do intra-week and intra-month, and then hot-foot it back above it by the end of the week and so forth. But, I do think that the markets now are in control and transitioning, and when they fully transition, namely stocks top, Europe already has, Japan has, but the U.S. clearly does, and bonds top, and commodities turn up. At that point, it's a full court press against the central banks. They will be washed to the side, no question in my mind.
I mean, just think about it. These pension funds and the like have to go out, and take extremely risky assets, and now all of a sudden, to the extent that they're still in these fixed rate instruments, they're going to find themselves underwater like mad, and then they're going to be out on taking risks in places they never should have ever been taking risks. It's going to be carnage for the pension funds. You talked about that some time ago.
That's one of the next levels of the crisis is the pension fund crisis, because of the demographics and the failure to have yield, to find yield without taking extreme risk, and thanks to the central banks. and thanks to it occurring over a period of years, not just a few quarters. But this is getting it straining now. It's years of this. The CalPERS came up with some 1% or something gain last year, and they need 7.5%.
Good Lord!
You can't do that 2-3 years in a row. You have a disaster. So,
all right.
But
well, Michael, we have a good friend who has been a teacher in New York City for a number of years and a fantastic pension. And he's guaranteed, supposedly quote unquote guaranteed 7 or 8%, annual returns, but. That's not in the market. There's no way in the market. So what they've done is they've put the taxpayers of New York City on the hook to they're going to just raise their taxes, I guess, to the point where they can pay the teachers' unions and the fire and the police and whatever else. So it's
a tax rebellion, but that's always a possibility. But I don't know. The pressures are becoming extraordinary and everywhere, especially with investors and those who have capital. There's a lot of Americans don't anymore.
No.
But I even think the 1%ers are about to face a lot of pain. They've enjoyed the ride because the banks have paid for it. But I think that which they're sitting in is not going to be going the way they want. And I think it could become pretty sudden. It's been slow in arm wrestling for this year, except for some jolts up in oil and gold, for example. But I think once the food commodities join in, it's going to be headline-type material that inflation's back, but it isn't 2%.
Yeah, you talk about the arm wrestling. It reminds me, you also use colorful images like plate tectonics, and these plates grind against each other very slowly. You don't realize they're moving hardly at all, and then all of a sudden, kaboom! You have an earthquake. You have all of a sudden you reach that limit of stress when the thing can't take it anymore, and then you have a sudden unraveling. And that's what I think you see coming. And I have to ask you talk about I think the JGB was what you were most concerned about, perhaps that's the Japanese long bond, right? And that looked very precarious to you. Is that still the case?
Well,
and if that goes...
So do the bonds. And I think they'll all three go together. They're all the three safest, quote-unquote, most manipulated long-term debt instruments, U.S., German, Japanese. And they've pretty much been under the same sort of influence and pressure by their central banks to get yields down. There's some differences. We didn't go negative like Germany and Japan, but we got close, as close as we could probably ever get. But I think they'll come unravel together. And I think the three central banks will all be quite frightened, and it'll be a sudden event. And I suspect investors will cease to have give any credence to what the central banks say at some point. Right now, we're still hanging on to every word Yellen says. And by the way, I think last week she gave or earlier this week gave a speech somewhere, and I think she was the one, or maybe it was another Fed member, that 3% would be okay.
Yeah.
Before they got concerned about raising rates. They're...
Yeah, they fudge. They move the goalposts. They move the goalposts all the time.
I think that was the point of that 3. So.
Yeah. Yeah, it's whatever it takes to keep in control and keep people believing that the Fed has the magic wand, and which is, of course, the big lie. Well, I can't let you go before we ask you about gold. BlackRock's Heidi Richardson, recently I saw her, I think it was on Bloomberg, and she's talking very bullishly about gold. She's talking about the possibility, I think in her view, a probability of new highs for gold within 2 years. Is that something you think could happen?
I think she's probably wrong on the 2 years. I think it would be sooner than that. I think incrementalism, I'm a believer in chaos theory, and once certain pressures occur, they occur at a seemingly incremental pace. They get more and more, and then suddenly there's a snapping point, just like how stocks collapse sometimes, and gold exploded out of its lows of last year rapidly after February. When it went through 1140, it was all of a sudden went $200 more in a few months. So I think the same type of snap effect, sudden change, can occur. So that if gold is going to make a new high, it's not going to crawl its way up there. I think there'll be some event-type macro event that will spark gold to rapidly gain ground. Perhaps even $100 a day type ground, and not have to fight its way all the way back to the 1900 peak of 2011. So I agree with her, but I suspect she's going to find she's right, but gave it too much time.
Yeah, I don't really know what her thoughts are on that, and I can't remember exactly, but it caught my attention. And it seems to me, you're talking about the sort of major catastrophic event that could take place. You could be looking at, interest rates popping up the Fed not being able to do anything about it, because if they tried to tighten up like Volcker did in 1980, it would just really cause tremendous carnage immediately, and so. A loss of confidence in the system probably is what could cause gold to, for whatever reason, could cause gold to rise to very rapidly to new highs, I suppose.
Yes, it could probably be any number of things. You and I could sit and chat about it and figure out three things. And it might be a combination thereof. But the pressures have been put in place where the distortions are so great now that once they come unraveled, and one major asset class, let's say the commodity uprising, I call it. When food joins oil and gold, that's going to be noticeable, and it's going to have a total. It'll cause investors and analysts, especially, to revamp totally their vista of price future in this asset category or that asset category because of the commodity price inflation that suddenly springs on them.
So the bottom line, Michael, as we're running out of time here, is that investors want to be positioned for this major earthquake that's going to take place when these shifts, when these plates shift and give way, and we want to be probably
unleveraged. We tend to argue don't go in like a futures trader and use tenfold leverage.
Oh, absolutely, I agree.
You got to be gradualistic, incrementalistic. Build your position slowly. Preferably a cash type position, because these moves are going to be big, even if they're unleveraged. That's our view.
Yeah, absolutely. Keep out of debt and just go with cash and so forth. Yeah, very good advice. Well, thank you very much, Michael.